Okay, in this one we're going to look at interest rate structure. Okay, and this information here comes from a hypothetical example that I created. We have a AAA corporate bond rating. We have a BAA corporate bond rating. Yields for those two, 8.84 and 6.71. The price of a BAA is going to be lower than the price of a AAA. People are going to bid down the AA or BAA because it's going to have more risk, which is why the yield is higher on the BAA relative to the AAA corporate bond. The Treasury has yield maturity of 4.82. The municipal is lower than that because municipals are tax-free, and Treasury inflation protected securities have a yield of 1.4. And the reason why the TIPS is so low is their price is much higher than a similar Treasury. The price of a TIPS in this case is much higher than the price of a Treasury because people want to pay for protection against inflation. And a TIPS bond, unlike a Treasury, the coupon payments are adjusted for inflation throughout time. Okay, so that's our basic information here, and I've already copied and pasted it to Excel here. Okay, so expected inflation is the difference in the Treasury and a Treasury that is protected by inflation, where the coupon payments are increased as inflation increases. So the inflation expected inflation, according to the market, is 3.42%. If the interest rate on a 5-year bank loan is 8.19, so this is the nominal rate of interest. We'll call it I. Okay. The nominal rate of interest on this bank loan is 8.1, right? The real rate of interest accounts for the inflation, the expected inflation. We go back to the Fisher equation, right? So the real rate of interest is their difference. Okay. 4.77%. Because remember, the Fisher equation is I, the nominal rate of interest, equals the real rate of interest plus inflation expectation. So we'll call this expected inflation. Okay. Default risk premium, if you remember what default risk premium is, default risk premium is the difference between a BAA. Remember, BAA's in that chart. The yield skyrocketed during the Great Depression, but the AAA did not. So I think most of the difference between a BAA and a AAA is default risk premium. So we're going to call that difference the default risk premium, 2.13. The illiquidity risk premium is the difference between the Treasury and, I would say, the best, whoops, I got it backwards, the highest rated corporate bond. Because remember, Treasuries got a huge market, corporate bonds are traded on a much smaller market, so that's why I consider this difference to be the illiquidity risk premium, 1.89. Okay, the tax exemption discount is the difference between the municipal and the Treasury. In this case, 2.42%. Okay, the risk structure of the BAA bond. The risk structure. Now remember, there's no tax exemption discount, right? The risk structure of a BAA bond is the sum of these two. That's the risk structure. Okay. We don't include the tax exemption discount because BAAs don't get a exemption from income taxes. So it's just the sum of the two. So this right here is called the, you can call this the risk structure. We'll highlight that. Okay. Okay, moving on. We have a list of one-year treasuries. This is what the 1 year is today. This is what we expect the 1 year yield to be in the future. This is what we expect the 1 year yield to be in 2 years from now. This is what we expect the 1 year yield to be 3 years from now. This is what we expect the 1 year yield to be in 4 years from now. And this is what we expect it to be in 5 years from now. Okay? According to expectations theory, the yield on a 5-year treasury equals what? Well, remember, we have to average the 1 year bonds that are consecutive, right? We got to average these 1 year bonds to get the 5-year treasury yield, according to expectations theory. And that is 5.246. Okay? The maturity premium on a 5-year bond is the difference between the 5-year bond rate and the 1 year bond rate. So the maturity premium here is 0.426%. My open math didn't like the 3 decimal, so I changed it to 2 decimals. Okay. If the liquidity premium is linear maturity and given by this, the liquidity premium is calculated over here by doing this. So we're going to multiply. It's a 5-year bond, so we're going to change that into 5 and then hit enter. So the liquidity premium is 0.92 on a 5-year bond. Okay. Okay, so according to the liquidity premium theory, the term structure of a 5-year bond equals what? The term structure. Okay, the term structure is just the maturity premium plus the liquidity premium, according to liquidity premium theory, which is 1.346. Maybe 5. Yeah, there we go. Okay. Okay, the risk and term structures of a 5-year BAA bond is what? Well, remember the risk structure was of the BAA bond was 4.02. The term structure of a BAA bond was 1.346. This is the 5-year, right? 5-year. We'll type 5-year up here. So the term and risk structure of a 5-year BAA bond is this. Okay. The yield on a 5-year BAA bond is, so we got the term and risk structure, but we have to add to that what the yield is on the 1-year bond. So the yield on a 5-year BAA bond, when we include the risk and term structure, is going to be 10.186. Okay. Now, what about the real yield? Remember the Fisher equation. We got to subtract off expectations theory, right? Or the expected inflation. We're going to subtract off the expected inflation, which is 3.42. So the real yield on a 5-year BAA bond is 6.766. Okay. Okay. Suppose the economy has grown at 2.5% per year, and the tip spread has been fairly constant, Okay? If the yield on tip starts to trend up, so if tip starts to go up and conventional treasuries start to trend down, that means the tip spread is being squeezed. So the tip spread is trending down. And this means the market's valuation of expected inflation is trending down. Whoop. When this happens, when the Fed starts to think that expected inflation starts to shrink, right? The Fed's goal is 2% annual inflation. If the tip spread is squeezing, that's the market's expectation of inflation. If that expectation gets down to 1, the Fed wants to do what? The Fed wants to reinflate. So the Fed is going to maintain, because it was in a recession, it just came out of it, it's going to maintain its expansionary monetary policy. Okay? Now, what does this tell me? What does this tell me? It tells me that Hal Snarr is going to keep, Hal Snarr keeps the money in his retirement account in a low fee stock fund. And the one I have is a no load S&P 500 stock fund. Okay, so that's interest rate structure. That concludes it.